Hi traders, welcome to the Ken Tank, where you'll learn how to avoid getting eaten by the sharks on Wall Street. As always, all information is for educational use only. I'm not making advice about what to buy, sell, or hold. Hello active traders, this is Ken Calhoun from Trade Mastery and Day Trading University coming at you with another episode. Let's start off by looking at the S&P. The reason it's been going sideways the last several weeks is because the broad market is waiting for the election results coming November 8th. We're likely to see continued sideways chop and churn because institutional traders don't want to put on large position sizes until after the election data is out. The market hates uncertainty, so we're likely to see continued choppy markets between now and November 8th. So what you want to do as a trader is develop a very specific trading plan to trade the reaction to the election results. We're likely to see either a big sell-off or a rally after November 8th, so November 9th and 10th and so forth. So what you want to do now is start putting together a game plan or a trading plan to trade the reaction to the election news. In the meantime, let's take a look at oil and gold instruments, ETFs and ETNs, to see where they're headed and how we might develop a trading strategy based on current market volatility. We will start off by looking at our gold miners, which are all down, and we'll start off with ABX. ABX has gone from 19 down to 16. GDX, GG, NUGT, Newmont, all very good instruments to trade gold. They've all been going down. What's been going up has been the triple inverse gold ETF DUST, and I'm currently long this myself, DUST. It goes up when the price of gold goes down. You'll notice that it has my favorite chart pattern, which is a minor gap continuation. DUST is worth keeping on the radar in case it continues on up. What I like about it is the upside potential. If you look at a daily chart, say over a 2-year basis or a 1-year basis chart, you can see it had been up here at a split adjusted price of $1,000 a share, now on sale for the low price of just $50 a share. So while it's not a good idea to catch a falling knife, there is plenty of upside potential. And what I like about it lately, if we drill down to the 3-month chart, is we can see that it's broken above both the 50 and the 100 simple moving average lines. And so we'll see if it continues to fill this region or continue on up. What I do like about it is the fact that it's gone up lately and it's climbing up out of its previous trading range up to new highs. So DUST is one to keep on the watch list. The other way to play things is if the price of gold comes back and we get a recovery, to play a pivot inside the bounce region, either for quick momentum plays here or up in here, for example in NUGT or the other instruments. They'll have the same, pretty much the same exact chart pattern. ABX, GDX, GG, NUGT, they're all tracked to the price of gold, so the chart patterns look pretty much the same. You may want to consider bounce plays because they are selling down pretty sharply, and we've held support here the last couple of days, at least Thursday and Friday. We may see a pivot. I wouldn't be too optimistic about that. I'd rather just scale into or build my trade in DUST if gold continues to drop. So either a pivot in the regular gold miners if they do get buyers coming back into them, like this chart GG, or I'm a continuation in trend trader, so since this is up at new highs, I'd like to build a trade by continuing to buy additional shares, which I will be in DUST if it continues to take out new highs. Now let's shift our attention to oil. What I like about oil is that crude has been lifting up to new highs as well. I'm long UWTI, which is one way to play crude. If you take a look at the name of that, that's the Velocity Shares Triple Long Crude ETN. And there's a number of them out there. They all have similar chart patterns. That's a side note. That's the neat thing about trading commodities like oil and gold is you can pick your price and you get the same chart pattern. Like here's oil. You see it's only $6 a share. If you look at UWTI, identical chart pattern, it's $27 a share. Now there's more points of volatility in UWTI, of course, than oil, or UCO, which is a 8 to 11 priced instrument, or USO, another one that has very similar price near $11 a share. Another way to play oil to the long side is the instruments like British Petroleum, like BP is one, or Halliburton. the charts are all pretty much the same. So you can pick and choose from among which of those makes the most sense for your own personal trading style. I like trading a handful of instruments, and you can see the lift in crude looks very attractive. The reason is because, as with some of these other instruments that have sold down sharply, if you look at a longer term chart, the upward price recovery region is significant, right? This had been split adjusted up at $1,200, $1,800, $2,000 a share a couple of years ago, and now it's $28 a share. So if it continues its upwards trend, it may make sense to look at for potential entries to the upside. And again, these aren't trading recommendations, it's just what I'm looking at to do in my own trades, but I always like strong trending instruments like UWTI for oil and dust to go short in the gold market. Be sure to join my subscribers at swingscans.com and tradingtheopen.com so you can see these types of alerts in each week's markets.